Hey guys, David Robinson here. Welcome to the apartment investing journey. Another week, another great guest, and I'm excited to share the journey that our next guest has been on over the last handful of years. We connected a few years ago, and in a short period of time, he's done some things that I think will resonate with a lot of our listeners today. Starting in the smaller multifamily space and then bridging that gap into larger commercial multifamily. And so, Lee Yoder, thanks for coming on the show. I appreciate you coming on.
Yeah, it's an honor to be on the show, David. This is one that I've been listening to for a long time, so it's a little bit surreal to be a guest, but I'm glad to join you today.
Well, thanks for that. So, Lee is a husband, father, and real estate investor. And he used to be a physical therapist and was successfully climbing the corporate ladder, but wanted more control over his time and his family's future. And by investing in apartment buildings, his wife and Lee have been able to quit their corporate jobs and are now living the life that they feel like God has called them to. So, Lee, very, very brief bio, right? We want to get the entire journey and the entire story. And so, if you don't mind, let's back up. Let's talk about this path that you've been on. Our listeners want to sort of glean from you the journey that you've been on over the last handful of years and take out the nuggets, the good stuff that they can apply to their business, maybe learn from some of your mistakes, maybe learn from some of the things you did really well and apply it to their business. So let's back up and let's talk about when you first started even exploring the idea of getting involved in real estate.
Yeah, sure, David. I like to tell my story because I didn't do anything crazy, anything special. I don't have any special talents or anything, but learned about real estate, bought into the idea, and took some action and consistent action, right? So, yeah, I'm a physical therapist by training. Was doing the outpatient thing, didn't love the schedule, so got into home health physical therapy, where you get to drive around, go to mostly older folks, go to their house. So I got to make my own schedule. Lots of flexibility. So it was great for my family, for my wife and I, as we were starting our family, but I was just really bored. It was not challenging, exciting, fulfilling at all. So the company I was with asked me to be the clinical director and come in the office. So I split my time between actually doing therapy and being in the office, and then quickly grew into a role where I was in the office full time. So I wasn't doing physical therapy anymore, and started to realize, for the first time, that this is what I really liked is and I didn't really know exactly what that was, but it was more like the business and numbers and crunching numbers and doing, like, I was really more of like a director of operations. So I really enjoyed that. But now, David, over the next couple of years, I had a job that I really enjoyed. It was exciting, fulfilling, challenging, all the things that home health physical therapy wasn't. But then it was also what a lot of people have experienced with climbing the corporate ladder. It wasn't so good for the family. I didn't have control of my time. Even when I was home, I was pretty, I would say I was stressed because I really liked it, but I was consumed is how I would say it. It was hard to control it. And then, this is pre-COVID. I had to be in the office a lot. Like I had to be away from home a lot. So after a couple of years of that, honestly, and adding another child, and my wife and I kind of thinking, like, this is the type of job and the fulfillment that I'm looking for in a career, but it's not the life that we feel God has called us to. So kind of started looking around, and a close friend of mine at work, a coworker, gave me a real estate book, and it was kind of a random book, but it kind of got me going down that rabbit hole. I read Rich Dad Poor Dad, like a lot of people. The light bulb kind of went on, and I read more, and I thought, okay, maybe this is my answer. Maybe real estate is the answer of having an exciting, fulfilling career, but one that I can control, so I can still, have that time freedom. So I talked to a buddy, and I like to share a story because I would share this with your listeners, David, like you mentioned, that maybe they're wanting to get into this. I think post-COVID now, more people have a chance to do this, because my buddy said, well, Lee, could you do your job from home? Could you have more flexibility so that you could start real estate as a side hustle, get it going, and then maybe eventually leave your job if that's what you want to do? And the answer for me, David, at that time, as most, was no. I'm not allowed to do my job from home. I have to be in the office, 8 to 5 at least every day and all that. So I did not have the extra capacity. So that's when I decided, though, okay, well, when I was doing home health physical therapy, I had a lot of freedom, a lot of mental space. Like, I wasn't challenged at all. I felt like I had a lot of bandwidth. So that's what I did. I left that job, took about a 25-30% pay cut, but I went to a job where I knew, it was still paying the bills, like, plenty for our family. Wasn't like we were in distress or anything. Don't want to over dramatize the story, but
Sure.
We did take a big pay cut, but I knew I would have the flexibility, the freedom, the bandwidth to get into the real estate. So that was at the end of 2016. It was, the fall of 2017 that we got our first property, started with a flip, but that was kind of the mindset and the idea behind why I want to get into real estate, and kind of how I started to make that transition from a corporate job that left me no freedom to do that, to going back to a job that did allow me the freedom to get into it.
And just to give us some context, what did your family life look like at that point in time? Just you and your wife, any kids? What did that look like?
Yeah, so we had two kids by that point.
Okay.
Yeah, so two young kids, and my wife, she's a nurse. She was working PRN, which means, kind of every once in a while. But the funny thing is, when your wife stays home, at least in my experience, you do have more flexibility because she's home. But like, it's hard to be home with kids all day. I mean, I can speak from experience just doing it on the weekend for the most part, or when she's gone or something. So when the partner that's working is working overtime, you're working overtime at home. And so in a way, it was like I needed to be home even more since she was home all day, versus if she was working, and she comes home, she hasn't seen the kids all day. She'd be, wanting to spend
She has
time
the
with them.
energy
So,
for it.
right.
Yeah.
It's right. It's very different. It's just a different kind of work. So, that was kind of our setup there, where she was like,
Okay.
I'm ready for you to be home around 5 o'clock in the evening, I'm
Yeah.
ready for you to
Yeah.
tag in.
Yeah. So that, that grind of working that, corporate ladder started to wear on you. You recognized,
Yeah.
hey, maybe this isn't the right path for me, even though it was fulfilling what I wanted from a challenging perspective and being in
Right.
the business side of things and, directing a business systems operations. It wasn't necessarily the right path for you from a family perspective. And so that's
Right.
when you decide to make that change, take a pay cut, get into a new role that allowed you to work from home and give you more flexibility, and start to build this real estate business on the side. And so It sounds like, did I hear you correctly, roughly fall of 2017 when you
Correct.
purchased your first property?
Yes, absolutely.
Okay.
Yeah.
So we want to bridge the gap between, that first acquisition and where you're at and what you're focused on today. But let's start there. What did that deal look like, and how did you go about it?
Yeah, I started like many, and just decided to start with a single family flip. I mean, my wife and I are different. God, often puts people together that are different. So her risk tolerance is a little bit lower. So we kind of met in the middle, where we bought a single family home because we knew, David, that if things didn't work out, we could afford the mortgage on that home and our home. So that was kind of like worst case scenario, right? Can't take us under. Worst case scenario, we're paying off two homes, paying off two assets, the way I look at it. So flip that house. I learned the lesson quick, and luckily I was listening to guys like you, David, and you bring on guests. And so I have people in my ear going, hey, flipping is not investing. Flipping is another job. And I learned that pretty quick. So on that first flip, it took about 9 months, which that was fine. We weren't in a big hurry. I wanted to just do it at our own pace. I didn't want it to consume us. That was what I was experiencing in the corporate world. I wanted to show my wife that real estate wouldn't do that. Well, unfortunately, we kind of got to like February, March, and she's like, hey, you want to have this ready by May 1st? Think about how many projects you still have to do. And I did a lot of work myself just to keep costs down.
Sure.
Worried about that. And so I kind of had to go all in there at the end. And it was basically like being back at the corporate space as far as the amount of time I was putting in. So we totally got that experience that many people have talked about on your show, David, where it's just another job. The funny thing is we made about 30,000 on that flip. And I just share that because that's about exactly the amount of pay cut I took leaving the corporate job. So I truly just switched like a busy corporate job for a full-time, not busy job, but adding a flip on top of it. So now I did learn a lot about real estate, so I don't totally regret it.
Sure.
Right? Like a lot of people will say, I would never do that deal again, but I'm glad I did because it got me. And I would say the same thing. So I had two goals: was to prove to my wife that real estate could make money, and to prove to my wife that real estate was like going to provide us this great lifestyle. I only hit one of those two. We did make money, but it showed her like, no, this is like you get so busy, you do all the work yourself. So yeah, again, luckily I'm listening to podcasts like yours again, where people are like, go bigger, think bigger. You don't have to start small. So I didn't take that big of a jump, but I did jump into a duplex next. In both of these, you asked a little bit, we bought both of these at auctions, which in my opinion is a good way to weed out some of the buyers because you have to go all cash. We used a home equity line of credit and some family to help us be able to take that down cash and pay for all the rehab. So that's how we did the first two. This duplex we got at the county auction and went all cash and stuff. Pretty much flipped that. I did rent it out for a little bit, and I managed that myself as a landlord. So got a little bit of experience in that, but also just realized that's not something I wanted to do. Again, I'm just the whole time I want to go bigger. So we sold that in under a year, did well on that, as a flip as well. And then joined my local RIA here in Cincinnati, Ohio. And that RIA has an apartment focus group. So in that focus group, the guy leading that started, teaching me more about underwriting multifamily deals, because it is different. Commercial multifamily deals, it's very different. So got better and better at that, and just jumped on LoopNet. Started looking at deals, kind of send them over to him. He was very gracious with his time, and I'd say, hey, I think this one looks decent. $50,000 less than it's, but then they're asking for it. What do you think? And he said, yeah, your numbers are good. Go ahead and make that offer. So kind of start making offers. He gave me some confidence to do that, and eventually found a property on LoopNet. And you won't believe this because it's not possible in 2021, but the property had sat on LoopNet for over a year. Wow. And got it for I think I got it for about $90,000 less than what they were asking for it. It was a distressed property. So that was a 16 unit property. Everything I did was pretty close to me. This 16 unit was 20 minutes from my house. So that was how I got into multifamily. And then I'm sure you've talked about, David, you hear people talk about the law of the first deal with multifamily. I know another podcast talks about that. And that was totally the case for me, because the day I was closing on the 16 unit, I wrote an offer, full price offer on an 8 unit that we ended up getting on contract. And then about a month and a half or 2 months later, we got a 10 unit under contract. So wow. I hadn't done, a true multifamily deal in the fall. This was in the fall of 2019 now. We closed on 3 small multifamily properties, and then spent the next year and a half repositioning those 3 properties.
Wow, that's awesome. So this is a great story, and a lot of our listeners can relate to this, right? A lot of the listeners to our podcast are those that either love being in the small multifamily space, and that's where they want to spend their time. They have no interest in going beyond that. And then others who are in the small multifamily space and want to, move into larger commercial multifamily. So talk to us about some of the challenges that you faced in the small multifamily space and some of the benefits. Like if you were guiding a new investor that's interested in small multifamily, maybe even owns, like what are the arguments for small multi in your opinion, as well as the arguments for going bigger?
Yeah, that's a great question, David, because I think there are some definite benefits, and we can get into more. So right now we're kind of syndicating. I would still say mid-size, we're under 100 units, but it's very different. So the small multis are a great way, in my opinion, to get quicker cash flow and keep more of the deal, keep more of the cash flow for yourself. Because they're just really easy deals to put together. The way we did it, was just with 1 or 2 investors. So just me bringing one other partner, and we would just do joint ventures. So very easy. You create an LLC, you buy the property through the LLC. And, when I'm underwriting, the way I do it, David, is I say, okay, well, if I'm asking this investor to bring in $100,000 or 2 investors to bring in 50 each, what's a good return on that? And based on my projections, how much of the deal do they need to have? So easy example, if 2 guys are bringing $100,000 each to the deal, and I think 25% provides them a good return, maybe provides them $10,000 a year, plus the equity upside, that's a 10% return for them. That's a good return. So I give them each 25%, means I get to keep 50. And I brought no money, but I've got the deal and I'm going to manage it. So that's, I think, a definite benefit. Is it's really easy to put together. You can do it with just a few people. You could do more of the work yourself, I guess, and it's going to be easier to manage probably than a bigger property, because you don't have to be quite so professional. There's less moving pieces, I guess. I still use property management. I had no interest in managing them myself. And I would say small multis are still, it's better than single families, trying to scale single families as far as having them managed. So a property manager, taking a 16, an 8, and a 10, that's more worth it to them than if I bought 3 single family homes, right? So there's a little more scalability, but jump into the bigger stuff, I would say just the bigger it's easier to scale, because I, had a goal of replacing my income, as most do, and having a certain number of doors and kind of building up this portfolio. And as you start to accumulate smaller multifamilies, you just go, man, like, I've already got 3 different loans. I've already got 3 different LLCs. I've already got 3 different properties that I'm keeping spreadsheets for, kind of managing the manager on each one of them. One of them ended up being a little bit too far out for the property manager that I like to use. So I had to pick up another property manager to take that one, because it just wasn't worth it for them to go all the way out there for an 8 unit. So some of these things, I mean, a lot of people talk about, there's just the scalability of it. You can't quite scale. So if you want to have a small portfolio, and certainly if you want to manage it yourself, I think staying smaller is a great idea. If you just want to, hey, me and I've got a couple buddies, a girl from church, a couple family members, and we just want to build a small portfolio and manage it myself, absolutely stay small multifamilies. I think that is like the holy grail of the way to build that portfolio. But if you really want to scale, if you want to involve even more people, if you want to build kind of more of a business, then I would say keep going bigger and get bigger properties. It's going to lend itself to building a true business that, you can bring a couple partners in on, you can specialize in an area. When you're doing it all yourself and small, you kind of have to do a little bit of everything. And I kept running into things where I'm like, man, I would rather add a partner to do this, but to do that, I think you need to go bigger so that it's a bigger pie, right? More people can have, a piece of a bigger pie.
Yeah, love it. That's a great summary and great explanation. Thanks for taking some time to do that. So let's take the story forward a little bit. Here you purchased the 16 unit, 8 unit, and 10 unit, all within a very short period of time. This is roughly 2019. And so what does, the next 2 years look like for you?
Yeah, so the next year, I really was very hands-on. Like I said, had a property management company working with me, and they're doing the day-to-day work and very involved. But I was very involved too, kind of as the general contractor, because a couple of these were very heavy value add. The 10 unit was 50% vacant, and someone left right after we got, so 60% vacant. So, and we did a bunch of the exterior. So that's what my time was. I did throw another flip in there. But I was very involved in the project, contractors and stuff like that, and had a lot of fun with that. My job, I was still full time. My job allowed me to do that. Then COVID hit, obviously, and as a home health physical therapist, my hours dropped significantly because a lot of what we see are people that have had a total hip replacement, total knee replacement, and that was all put on hold. Right, you couldn't have elective surgery, so I was doing almost nothing, which I loved because that was my goal. Right, so now I was like, had to be all in on real estate. And so I was also really blessed to have that. So, David, like I mentioned, my goal, as many have the same goal, was to replace my income. And so I'm doing the math in my head, and just to throw out some numbers, on these 34 units between these three buildings, if I would have held them all long enough and had them all stabilized, I probably would have been about halfway to my goal. I probably would have made about 30,000 in an annual income off of these three properties, annual profit, because I owned about 50% of each. And my goal was 60. And so I thought, man, I got to do this again, which wouldn't have been so bad, but I wanted to quit even earlier. I didn't want to wait that long. I didn't want to wait another year, a year and a half. I was getting pretty antsy, wanted to get into it full time. So also, the market went crazy. Who would have thought a pandemic would have, helped real estate tremendously. So I'm seeing my values just skyrocket, and we were able to bring them around. So I actually sold 2 of them in the fall of 2020. Okay. And just decided to take all the equity off the table. We did pay taxes. It was, long-term capital gain. So it's a lot better than ordinary income, but we didn't pay taxes. But that basically, the way I looked at it, David, was brought forward 6 to 7 years of income today. So I kind of told my wife, well, we have 30,000 a year, and that's only halfway there. And we say we need 60. Well, what if we could have that in our bank account and kind of have a cushion for like 3 to 4 years? Would that make you comfortable enough for me to quit? And we decided it was, something we prayed through. And so that's kind of what I did. I went the selling route and brought the income in to live off of while I go full time. And so we have a cushion, and, I know I could find a job as a physical therapist if in 3 years I can't get this going. But that's what we did toward the end of 2020. I actually sold the 10 unit as well just a few months ago, but then started trying to get into apartment syndication. So trying to go a little bit bigger, and partnered up with, interestingly, the guy that was working with me on the corporate side that handed me that real estate book. He's now my partner.
Oh, really? That's
full-time.
Great.
Yeah. We're both full-time in the real estate business and have been since it's basically like October of 2020. And it took us until February of this year to get our first apartment building that we syndicated. It was a 45 unit apartment. And then in mid-June, we closed on a 47 unit. So those are the first 2 apartments that we've, and those are in our area as well. Like I said, we live between Cincinnati and Dayton, Ohio, and pretty much all of our properties have been in and around Dayton so far. So we got our first 2 syndication deals through this year, and hoping to get a couple more.
Love it. Love it. Well, and that's a great segue for us to talk about that first deal, the 45 unit. If you can, maybe just describe for us the asset and how you ended up finding it originally.
Yeah, that's a good question because it's so hard. I mean, it's so hard to find good deals today, right? I mean, I think there's plenty of money and there's not enough deals. So to me, I know some people have success mailing. I haven't really gone that route. My route has been developing relationships with brokers that will, bring us the deal before they put it out so that we just have less competition on it. We're still going to pay. I mean, everybody knows what they have today. I think even if you go direct to a seller, there's probably not a very good chance that they don't realize that they're
Right.
sitting on an asset that's doubled in value, maybe tripled, maybe quadrupled since they bought it, right?
Right.
Depending on how long ago they bought it. So we've gotten some good relationship with brokers, and I met a guy actually. I think I met this guy through Bigger Pockets and noticed he was, local, and had him on my podcast, developed a relationship with him because he's kind of killing it in the Dayton area. And he's a newer broker, but been an investor for a long time. And he's looking for very heavy value add C, I would call it D class. He might say it's C class, but so the property he brought us is just one that doesn't fit his investing criteria. It's, so that's 45 unit. It's actually a 29 unit building and then 2 8-unit buildings pretty close to it. But he brought it to us because it's not something he wanted. And so he, on his broker side, decided, well, I'll just make the commission and help Lee out because we developed a good friendship. So we were the only ones bidding on that property. So while we didn't, steal it, because again, the owners, they know what it's worth. They know about the cap rate that things are trading at. But at the same time, we didn't have so much competition that, it's just, we're, bidding against each other. So we got in at a good solid, like 8.5 cap, 8.5 to even 9, which sounds probably crazy to a lot of areas in the country. And Dayton, honestly, those times, like this was, I feel like even since this was like, again, end of 2020, I feel like even since then prices have gone up, so much. But so yeah, and this was a pretty stabilized property, well, a very stabilized property. The previous owners had done a lot of work. And I honestly don't look for properties like that too much, David. I'm looking for a little bit heavier value add just because to me, that's the only way you can still get some really good value. The ones that are truly turnkey, the prices are just beyond what we're looking for in returns. But this one we were able to get, even though there wasn't a lot to do with it. The owners were just ready to be done. They're out of state. They were trying to manage it themselves for the most part. So yeah, just the guy that brought us the deal was the one that made us the money on this one. It was that relationship that brought us the deal. Yeah.
Man, that's killer. So talk to us a little bit about the process of negotiations as well as due diligence. Was there anything unique in there or anything noteworthy that we could discuss that might be helpful to the listeners?
Yes. One thing early on, David, and I've learned this lesson, both deals that we've gotten, I've noticed this to be true. And I think this is a principle across the board, that the sellers and the brokers, they want to know that you're going to be able to close the deal, that you really are going to, right? Because there's some big money out there, and even some of the smaller guys, like the thing they want to do is lock up the property. And then they think, well, then we can just renegotiate, we can beat them up. And then if we don't get it, okay, well, we're offering on a bunch. And so the owners of this property, this 45 unit, wanted to have a call with us. And we talked to them over the phone with our broker for an hour, like a group call. And they really wanted to get a sense that we were trustworthy, that we really wanted the property. We could close on it. We wanted to close on it. We were committed to it. And so before they even wanted to accept our offer, they wanted to make sure of those things. And we were able to convince them of that, hey, we're local, we're here, like we're not offering on a bunch of properties. We really want this one. We're going to take it down. If you accept our offer, if something crazy happens, then in the due diligence, we're going to have to retrade a little bit. But hey, if it's just normal stuff, because we're bringing some money to do little CapEx projects, so we are not going to retrade. We're going to commit, because they had already had it under contract once, David, and it went almost all the way to closing table, and then it fell out, and they just did not want that again.
Yeah,
they really didn't. So that was one thing true of this one. It was true of the second one. The second one way people are doing that these days is putting up hard money. We put up hard money on our second deal. Again, that's to prove to the seller and the broker that you are committed to closing on the deal. So that was one thing I learned there early on that 45 unit, that the seller, the broker, they want to know that you are committed and you're going to close on the deal. So we were able to convince them of that, through due diligence. Again, we found some little things. We didn't ask to retrade on those things because it was just stuff, we know we're going to spend some, even though I said it was a very stabilized, pretty turnkey property. There's always going to be stuff that the previous owner didn't feel like doing that you want to do. So yeah, through the due diligence, we get an inspector out there, and then he's the type of guy that knows a little bit about everything. And then he can tell us, hey, dig into this more. So we did that. But everything, looked pretty good, and we felt good about our projections even after due diligence. So pretty smooth closing on that.
Yeah. Sounds like it. Well, that's great. So moving forward into financing. So this was the first deal that you had done outside of, smaller joint venture. How did you end up structuring the deal?
Yeah, that's a really good question too, David, because that was a learning process. When you step up, everything I'd done up to that point, those joint ventures, those smaller deals, that was pretty easy for the banks to take those on. I mean, as I mentioned, one was 50% vacant, and we had 2 offers from banks, but it's a small amount. I did have a full-time job at that time, and all of the partners are signing on the loan. So 100% of the equity is signing on the loan. So you may have, with our deals, we had probably like 3 different incomes signing on that loan, right? They can come after 3 different incomes. Going into the syndication, my partner and I, we owned 50% of the equity, which is actually pretty high for a lot of syndications. I think probably the bigger the property, the less equity the general partners own. But even 50% was not enough for the banks. They wanted more than 50% of the equity, because we used actually a credit union in Cincinnati, a smaller bank and a great lender. But that's like the syndication model is just not something they're real comfortable with just a smaller portion of the equity signing on the loan. This is a lot bigger. This was a $1.68 million loan, whereas before, my smaller ones, they were like a $260,000 loan. So that's a big difference. The other piece of it, we were actually working with a mortgage broker, which can be very helpful. They did have trouble convincing banks because we were taking a big step. So we're taking a big step up. We had not done something nearly this big loan size wise or unit count wise, and only 50% was signing on loan. So we actually had to do a workaround. We asked a couple of our investors, and they were close to us, so it was okay, but I wouldn't want to do this again. They actually each formed their own LLC and signed a corporate guarantee. So it was kind of a workaround way for us to get 80% of the equity to sign on the loan. And they weren't guaranteeing it because it was this LLC that was just an empty LLC that only owned their share of the property. So if the bank would come after them, they would just come after that LLC, and the LLC owns nothing but the property. And the bank knows that. It was just kind of their way of working around. But again, I wouldn't want to do that again. But the financing was a challenging piece because we were working with a small bank. Only 50% of the equity was signing. It was our first time doing it. So definitely some things to work through on getting that first apartment syndication over the finish line.
Yeah. And just for context, what was the purchase price?
$2.1 million.
Okay. 2.1, you were getting a $1.6 million loan. So you're bringing about $500,000 of equity to the table, correct?
Correct. 550 for some CapEx and stuff like that.
Okay.
550 total.
And roughly how many investors did you bring into the deal with you?
7.
Okay. And so, and I assume these are mainly family, friends, right?
Yep.
Cool.
Yep, closer circle. Yeah. Right. The next one, as we've gone on, the next one, even it was bigger, higher purchase price, a lot more CapEx we're putting into it. So the second one, we raised 1.3 million with 23 investors. And as I'm finding out, like, as you keep doing it, like, you have to expand that network circle, right? So first it was like, parents, closest friends, other close family members. Then this 23, was like our parents' friends, our friends' friends, other friends from church, like somebody's uncle, and like, so you're expanding a little more. I'm sure the next one, it's going to be more of people we didn't even know, like no family relation, not a friend of a friend, but somebody that heard me, on your podcast. So slowly expanding.
Well, and if you don't mind me asking, I'm curious if there's anything that you could share to our listeners who maybe are in that transitionary phase for themselves, where they've done their own stuff, maybe small joint venture deals, and they're looking at doing a bigger deal, not quite sure how to structure it, know about syndication. Was there anything that you could share with our listeners that would be helpful as it relates to the process of structuring the syndication from a legal aspect, or what, that maybe you didn't think about going in, timelines, complexity, cost, anything like that you could share?
Yeah, there kind of is a lot there, David. Again, that's why I say, there's nothing wrong with doing the small multis. I mean, it's pretty simple, so there's definitely some benefits there. I mean, I had to mentor, like I mentioned, the guy that runs the apartment focus group for the Cincinnati RIA. He's done several syndications. So he was kind of there with me. But to me, it's all about your team. And when I say your team, I don't mean necessarily like, my partner or anybody that I'm paying. Right. I mean, my property manager who manages plenty of properties like the size. So it's just helpful to have people that are going to be working on your property. For them, I was like, hey, can you manage this 45 unit? Yeah, no problem. So a 45 unit seems like so big to me, but to my property manager, it's not at all. And then, we got a referral from me. It was from my mentor, but you could talk to others. And he referred to me the syndication attorneys that we use, and that is a $10,000 cost. Again, you don't have to do that on the small stuff. You can just do a joint venture. But, once we talked to those guys, David, and this was a big learning process, but I just got very involved that, they did a Zoom call, I think a couple Zoom calls with us. I went through the PPM, which is confusing, but I actually read through it. I highlighted a bunch of stuff, then had a Zoom call with them. And I just learned, it was so educational for me. So again, for those guys, this is a walk in the park. Like dude, we do these all day long. It's no big deal. Ask me any question you want. And they educated me. So through the process, but that's why I think one of the characteristics, for someone that gets in this is probably someone that's a little bit okay with like building the parachute on the way down,
Right.
because, I wasn't going to pay these guys $10,000 until I had a deal, but they weren't going to educate me and spend time with me until, I paid them $10,000. So,
Right.
You kind of have to a little bit put the cart before the horse, because it's just the way that goes. So I think you just got to trust that you're going to have people on your team that this is not scary for them. They do this all the time, and they're going to kind of educate you. I do think, beforehand, I did have that one mentor. So I think, have that one person that can, again, maybe give you some good referrals and kind of lead in that direction. So I would want to have at least one person in my corner. But then beyond that, you're going to add team members that each piece that they do for you is easy for them. So they're going to make it a lot easier for you.
Yeah. Love it. Great explanation. Well, I want to start winding down here a little bit. I've got 3 final questions for you. The first is, what's the biggest mistake that you've made on your real estate investing journey so far that we could all learn from?
Yeah, I think, so I'll keep it to multifamily. The biggest mistake that I made was underestimating the deferred maintenance. Because, when we took over these small multis, for instance, and it's really, or it's the case even on those 47 units we just took down, you kind of, how many units are vacant. And we even assumed like more are going to go vacant. Like as you take over and you instill something, like on our 16 unit, we were strict about no smoking in the building. And honestly, a couple of people left because of that. And we were okay with that, and we kind of knew that was going to happen. So our budget was really meant to cover the CapEx projects that we knew we were going to take on, and then the units that we knew we were going to turn, and then maybe a little bit extra. I underestimated, David, pretty significantly the tenants that stayed in place and were happy with us and happy with the building and okay with their increased rent. The amount of money that we spent on their units was shocking to me. And it still kind of shocks me, again, on this 47 unit, where I'm still a little bit surprised, because what I didn't anticipate was the way people are willing to live. And when they have an owner that is just, out of state and just doesn't care enough to answer the maintenance calls, and they do that for years and people stay put. I mean, we went in to switch out a lady's toilet, and we kind of just wanted to do it because, just newer toilets, low flow, stuff like that. I go in there and she goes, could you also look at my sink in my bathroom? I don't have running water in my bathroom and my sink. And I thought, what? And I looked and I'm like, well, you just have it turned off. She goes, well, that's because it's leaking so badly. And I'm like, okay, yeah, it is leaking really badly. Like, we need to get somebody in there. I said, how long has it been doing this? She goes, about 4 or 5 years. I'm like, so you haven't had a sink in your bathroom for 4 or 5 years? She's like, yeah, no one would fix it. So we fixed it right away. And that's, I don't know, a couple $100 cost. And that's just a small example, but there were so many things like that where I just never would have imagined that someone would still be living there with no sink in their bathroom, right? I would thought like, well, they'd have moved out by then.
Yeah.
So yeah, when you take on a property, and that's the properties that we want to go after, because those owners that are just done, that are checked out, a lot of times those are the ones you can get a good deal on. So we want those properties, and you really have to think like, you may be surprised how much money you're going to spend on the tenants that even just stay there, because there's so much deferred maintenance. Yeah.
Great point. What's the biggest win you've had on your apartment investing journey so far?
Yeah, one really cool win for me. I kind of mentioned before, how God brings opposites together a lot. My wife is very risk adverse, and she came from a family like that. So I think God wired her that way, and she was raised that way. But what's kind of been neat is actually my in-laws got involved in the first flip. Our home equity line of credit didn't come through in time because the guy that was working on it got fired. Long story, but my in-laws ended up fronting some of the money for us and kind of involved. And I think they didn't want to see their dollar go down in flames. So they kind of helped us out. So and it worked out well. We were able to give them a lower return than they expected, nothing on it. And then they didn't get on the duplex, but they're like, hey, we thought we'd get in on this one with you. And my wife was kind of like, really? Because they never invested in anything in their life. I mean, just bank account, right? Like they have their house paid off, no debt whatsoever, bunch of money in the bank account. Like that old school way of doing things that used to work. And now the Fed is making sure it doesn't work anymore, right? You can't make any money. So what was cool is they were our sole investor on the 16 unit. They kind of saw it working, and they saw like, the power of multifamily. And for, my wife's parents to entrust in me, I mean, it definitely, made me a little nervous alongside my wife. But then on that, we did really well on that one, and we're able to provide them a great return on their money that, they wouldn't have made anywhere else, and certainly not with it in the account. And then they've invested on these first 2 syndications with us. So it's been really cool. And that's what's fun. Cool. That's what, even kind of led me to do syndication, was like, I want to do this for even more people. I really believe in this. I believe in buying apartment buildings. And I think everybody should do it. Like, you don't have to do it actively like you and I do, David, but I think everybody should do it passively. If you've got some extra money, I think it's a great place to put your money, and seeing that work for people has been really fun.
Yeah, that's a big win. That's a good one.
Yeah.
All right. Last question I've got for you, Lee. What is the best advice that you have for someone who's just starting their apartment investing journey?
Yeah, I think the best advice is, you got to have a network. So I think you got to get some people around you. Like I mentioned, even though you're going to have other team members, you got to have at least that one person. I think having a mentor, I wouldn't be opposed to pay for coaching. I didn't have to, luckily, because I had a mentor that was really good to me that I didn't have to pay for. And I gave him a piece of my first deal, actually. So I guess I did end up paying him, but you go with that. And then I think, David, the tough part about multifamily, specifically when you get into it, is it's a long game. It's a really long game, even just to get a deal. So a book, The Compound Effect by Darren Hardy, is a good one to teach you that concept of, like, it takes a long time to see results, but when you do, when you're doing something and you hit that compound effect, you're going to see incredible results. The idea of doubling a penny every day, and even after 20, 25 days, it's really not that much. But in those last 5 to 10 days, it turns into like $5 million over a month, right? And that's kind of how multifamily is. So I think you have to have that mindset that it's a long game. It's the compound effect. It's going to take a long time, but you're going to have incredible results if you stick with it.
Love it. Love it. Great advice. Well, Lee, this has been a great episode. I'm glad that we were able to get you on. Your story is right in line with a lot of our listeners that are in that space, whether they've are looking to start to invest in multifamily because they've been in single family, maybe in the fix and flip space, and they're wanting to do more buy and hold long-term investing. And then those that are in that small multifamily space that are exploring the possibility of moving beyond their own financial means to take down a deal with maybe themselves and one partner or two partners, and moving into a space where they can take down a larger deal, but bring multiple partners to the table. So this is a great story, very inspiring, and thanks for sharing your journey with us. Lee, what's the best way for our listeners to connect with you? I know you've got your podcast, you've got your threefold real estate investing company. What's the best way for our listeners to connect with you and learn more about what you have going on?
Yeah, I would love for them to jump on our website, threefold REI, as in realestateInvesting.com. We've got an ebook on there, 5 Steps to Passive Income for the Full-Time Dad, that we're pretty passionate about. So I'd love to jump on there. And then if you have to put in your email, so then you'll be on our list, and that's a great way to connect with us. Our email is info at threefoldrei.com. Love to have you email us. I'm on social media and stuff, and check out the podcast. Any of those ways, I'd love to connect with people.
Great. We'll have all that info in the show notes. If Lee's story resonated with you, go down in the show notes right now, click on one of those links, connect with Lee, download his free ebook. Lee, again, thank you for sharing your journey with us, giving us some tips and strategies that will help us be successful on our own personal journeys. And I look forward to connecting with you again soon.
Yeah, you as well, David. Thanks a lot.